This is the Rational Reminder Podcast, a weekly reality check on sensible investing and financial decision-making for Canadians. We are hosted by me, Benjamin Felix, and Cameron Passmore.
Episode 50, 2 more to our 1-year anniversary.
Wow, yeah. Wow, I didn't even realize that it's been going that long. That's neat.
Yeah. So some very interesting topics this week, perhaps a little more technical than usual, but still, I think they're high-value discussions.
I don't know if I'd say more technical than usual. We get pretty technical a lot of the time.
Yeah, I keep trying to make us less technical, and you keep making the case we should be more technical, so be it. But I thought they were great topics, interesting. Talked about disability insurance as well, in addition to our portfolio topics.
Yep, so that's it. It was a fun episode, good conversation. We hope that you enjoy it. And I know I always say this, I hope people aren't getting tired of it, but we keep getting more and more new listeners. Every new episode has more first-day downloads than the previous record for first-day downloads, which I think is an indicator of more people listening to the podcast.
And lining up great guests, which is getting easier with better numbers. So we're getting great people coming on. So we've great guests lined up right through Labor Day, and love getting listener questions.
Yep, so keep interacting. Thanks. Welcome to episode 50 of the Rational Reminder Podcast. Just Cameron and I today, as usual, every other episode.
But we do have some great guests coming up.
Yeah, we do have some really interesting guests coming up. We're actually going to New York to speak with a handful of people that we think are going to be, they're going to make for some really good conversations for the podcast.
Anyway, so this week you had a listener question this week on a topic that's very near and dear to your heart.
Yeah, so we did get a listener question, and I know that Justin's been getting questions about it too, because he just wrote a blog post about the same question. So it seems like it's coming up a lot. We figured it's worth discussing it on the podcast again. But it's really just about the tax efficiency of VGRO, or any of the asset allocation ETFs from Vanguard and iShares.
Yes, these are the one decision ETFs. So VGRO is the 80 stock 20 bond, right?
Yep. So you buy the one ETF and it gives you the whole portfolio.
22 basis points of expense, automatic rebalancing.
It's a nice product.
It's very compelling.
Yeah. But the question that's been coming up is on the tax efficiency of those in certain types of accounts. So if you're holding, for example, VGRO in your taxable account, withholding tax is not going to be so much of an issue, but you start running into this issue of premium bonds, which is something that Justin and Dan have written about for years. Mm-hmm. And what a premium bond means is, if you think about a bond that's issued today, say market yields are, say they're 2%. So bonds are issued with a yield to maturity of 2%. If interest rates fall and market yields are now 1%, the price of our bond that's paying a 2% coupon is going to go up.
It has to.
And
this is key to understand the rest of the point of this segment. Interest rates have a huge impact on the value of those bonds.
On bond prices, right. But the change in the price of the bond is going to be such that the yield to maturity on that higher coupon bond is now going to be the same as market yields.
Right.
So in our example of this 2% coupon bond and the 1% market yields, the price of that bond is going to increase such that at maturity, because bonds always mature at par. So if a bond is issued at $100, it will mature at $100. Like if you buy a bond for $100, no matter what the price is over the time that you own it, I think people are generally aware of this, at the end of the term of the bond, you get your principal back.
So I get my $100 back, but I may have paid $110 for that bond, meaning at maturity I have a $10 capital
So this is the thing.
loss.
If you don't buy the bond at issue,
right,
like if you don't buy it when it's issued at par, then you're going to usually be buying it at a premium or a discount.
Right.
So like you just said, and I didn't do the calculation to figure out for my 1%, 2% example what the price change would have to be, but say it is $110.
But suffice to say, we've gone through an era of falling interest rates, so there's a ton of premium bonds out there.
Right.
So this is an issue that's widespread right now.
Globally.
And certainly in the Canadian marketplace, which is...
It's worse globally. I was looking at the numbers.
Oh, is it
earlier.
really?
Yeah, we'll talk about the numbers in a sec. So you end up with these expensive bonds that are paying a really high coupon. So you're getting a lot of interest income which maybe seems like a good thing, but in a taxable account, it's not so good.
Right.
Because you've got all this interest and then you've got a capital loss, so that before taxes, your yield to maturity is the same as every other bond.
Has to be.
But after taxes, because you're getting all this interest income, you're paying more tax on the interest, and then you're getting this capital loss, which could offset capital gains, which helps a bit, but only half of it can offset capital gains. Mm-hmm. So you're not going to net out after tax to the same return. So the way that you can summarize all this is premium bonds are relatively tax inefficient compared to...
In a trading account. Again, in an RRSP or a TFSA is not relevant.
Right, in a taxable account. So anyway, that's been the core of the questions that we've been getting on should I be holding VGRO in my taxable account because of the premium bond issue. Now, VGRO gets its bond exposure from 3 different ETFs, VBG, VAB, and VBU.
Yeah, that works well on a podcast.
Why is that funny?
I just find spitting out the acronyms or the trade symbols kind of funny.
Okay. Well, it gets exposure from bond exposure through 3 different ETFs.
So these are highly diversified.
Very, very diversified, which we'll talk more about in a bit. But between the 3 ETFs that they're using, you're getting global bond market exposure, hedged to Canadian dollars. So Canada, US, international, truly global bond market exposure. But you're also getting premium bonds. Now, the way that you can identify a bond fund that is holding premium bonds is you just look on the website. Like I checked before we recorded. You go on the Vanguard website, and for VBG, sorry to repeat the ticker, you can find the yield to maturity, and you can find the coupon.
Right. So yield to maturity is, give me an example of a rate.
So the yield to maturity for VBG right now is 0.9%, which is really low.
So that's how much yield you buy that. That's the average yield to maturity of the bonds in that portfolio.
Correct.
Made up of interest as well as any capital
gain
or loss.
Yeah. And then the average coupon for that same fund is 2.1%.
Wow.
So anytime that you have that, well, it's like we were talking about before. Anytime that you have coupons higher than your yield to maturity, that means that you're holding premium bonds.
And those coupon payments hit your tax return.
Oh, yeah.
Because that shows up as income, as interest income for your tax return.
Yep. And, I mean, funds, they can't distribute losses, right?
No, you have to use them.
Yeah.
I guess it'd be neat to look at the fund level to see how much on capital losses are they carrying forward for future gains.
Yeah.
Might make them very valuable going forward.
I agree.
We need to look at the balance sheet of the fund, actually.
Yeah. So then I looked at VAB as well, which is just Canadian aggregate bonds, and it's got a yield to maturity of 2.3%, average coupon 3.3%.
So you have enough capital loss to pull that 3.3 down to the expected return.
Yeah, to the yield to maturity, exactly.
So I think people get that.
So that's fine, and it kind of is what it is, but there are alternatives, which is why the question of tax efficiency comes up. Obviously, everything is tax efficient or not relative to something else. So one of the things that you can do is instead of buying VGRO, which has these 3 fixed income ETFs that hold premium bonds, you could just buy some other equity ETFs, maybe VEQT, the all equity asset allocation ETF, or maybe some other equity ETFs, whatever you decide to do, and combine that with some other form of fixed income. And those other forms of fixed income might be ZDB, which is the BMO discount bond ETF.
So it's like strip bonds.
No, not strip bonds.
But these are
discount bonds, not strip. Different.
How so?
How are they different?
Yeah.
Well, they're just bonds that are at a discount. Like we talked about how premium bonds.
Well, so they only buy discount bonds. These are not. Well, a strip bond would be a discount bond too, though.
A strip
there's
bond.
No interest payments on it.
Yeah.
But there's a strip bond fund out there.
Yep. First Asset has a strip bond.
Actually, that's the one that Justin did recommend a long time ago. I think he won a contest for that.
Yeah. I don't think it's done so well, and it's fallen off those model portfolios.
Interesting.
That's the First Asset strip bond ETF. Yeah. But anyway,
that's right. That's what I was thinking of.
So BMO has a discount bond ETF.
Right.
Which, like the name suggests, instead of holding,
but it must be hard to find.
Well, so you can tell by looking at ZDB, it is hard to find, and the way that you can tell that is the fact that it's actually at a premium right now, which I found interesting. The average coupon is 2.18, and the yield to maturity is 2.05. So it's much tighter, much tighter, but still at a bit of a premium.
It's still not a discount bond.
Yeah, but way closer than the others. And then the other thing that you notice is that it's got much less holdings. It's got 152 holdings. And when you compare that to VAB, for example, which is now we're comparing ZDB Canadian bonds to VAB Canadian bonds, but discount bonds versus aggregate bonds, VAB's got 949 holdings. But if we're comparing ZDB to VGRO, which has those 3 different ETFs in there, you've got VAB with 949 holdings, VBG with 7,661.
It's crazy.
And VBU with 5,789 holdings.
14, 15,000 holdings.
So you really, it's no comparison in terms of diversification. So anyway, the really important, I think that the really important figure to understand when we're talking about should you use VGRO or should you cobble together the asset allocation that you want using a different form of fixed income and equities, I think that the really important data point is the actual amount of relative tax efficiency that you're getting. So I looked at VAB and just made up a bond fund that's at par, but has the same yield to maturity as VAB.
Okay.
And just compare what is the after-tax return of the two. And you're getting a difference of a little bit more than 20 basis points after tax.
So that's the tax drag.
That's the tax drag from the premium bonds, a little bit over 20 basis points. Now, when we're talking about VGRO, 20% of the portfolio is in fixed income.
Right. So
the tax drag on your portfolio is 4 or 5 basis points on VGRO. So that's what you're trading off. And we just talked about the diversification.
And the auto rebalancing.
And it goes even deeper than that. I think one of the big things. Now, to be fair, the premium bond thing has been going on for a long time. But one of the big things that people need to understand with premium bonds is that bonds can't be premium bonds forever. The bond market cannot be at a premium forever. If interest rates stay the same,
then we have big problems. Well, if it does become a perpetual problem.
Well, yeah, sure. If interest rates keep falling, right, then we'll get into. I mean, I think Germany went into negative interest rate territory at one point. But even if interest rates stay the same, premium bonds eventually go away. If interest rates,
it's also the rate of change of interest rates too, right? So they change slows; they'll get tighter just as bonds mature.
Yep. And if rates go up, then bond prices fall. Premium
Correct.
Bonds stop being premium bonds.
Yep.
So this is a temporary issue, even if it's going to go on for a while, and I don't know how long it will go on for, but it is a temporary issue. So making big changes to a portfolio, such as choosing VEQT and ZDB instead of using VGRO, that's a big decision because you're giving up auto rebalancing. For a temporary issue it's a decision. So I think understanding those decision points is important in that decision. And then the other interesting points on this, just talking about that trade-off, so we're talking about this 20 basis point spread. Whenever you have a more concentrated portfolio, even if it's ZDB is still an index, it's still tracking an approximation of the Canadian bond market.
Yep.
But whenever you decrease your holdings, you increase the dispersion of your outcomes.
So chance of the return being a lot different than what you expected.
Right.
Lower or higher.
Right. And it's probably still going to be fine. Like ZDB's been very close to ZAG.
And it is still 152 holdings, which is way more diversified than picking your own bonds, which is what we used to see a lot of.
Right. But you would expect some dispersion.
Yep.
And obviously if the dispersion ends up being, it could be negative or positive, but if it does end up being negative, it could outweigh any tax benefits. But who knows what's going to happen. But the fact is you're adding a little bit more uncertainty by decreasing your diversification. And then the other big one, specifically when we're comparing to VGRO, although XGRO is similar too because they've got some U.S. fixed income exposure, but Vanguard and actually Dimensional too have done some really good research on currency-hedged global fixed income.
And this is so interesting, how you get exposure to different credit markets. When you take the currency out of the equation, you end up with their yield curve being the same as your yield curve.
Well, you end up with their yield curve in your currency
Correct.
terms. So you end up with a different
So
a yield curve that's different from yours.
But it has the same starting point is what I mean. Right?
Correct.
So you're able to get exposure, even though, let's say, interest rates in the other country are much lower, it doesn't matter. It's the yield curve that you're after.
That's right.
Their yield curve without taking on the currency.
Right. And Vanguard did a paper that we can link in our notes titled "Going Global with Bonds: The Benefits of More Global Fixed Income of a More Global Fixed Income Allocation." And they showed, it was actually fascinating. In the paper, they had 4 charts that showed for U.S., Canada, U.K., Euro region, and Australia, and they showed the sector exposure in terms of like what is the fixed income market made up of: government, corporate, securitized. And then they showed within corporate the different sector exposure within the corporate bonds. Then they showed the maturity structure of each bond market and the credit qualities of each bond market. And they're like vastly different, each bond market, which is just fascinating. Because if you just have Canada, obviously you're getting the Canadian bond market and its structure and its sensitivity to interest rates and Canadian inflation and all that stuff. But as soon as you add more bond markets, just like with stocks, you're adding more diversification. So Vanguard made pretty compelling arguments in that paper in terms of increasing the volatility reduction benefit of bonds. They made some pretty compelling arguments to adding global fixed income, which by definition you're losing if you just go ZDB. You're gaining tax efficiency, losing diversification.
And that's pretty intuitive, right? You want more diversification, more countries, more economies.
And the other thing that a lot of people do is that instead of using ZDB, they might use GICs in place of fixed income, which can be fine, but it's got also portfolio structure implications. Obviously, the same diversification arguments apply when we're talking about GICs versus VGRO. Now, I guess it's important to point out GICs are always at par for tax purposes. Like you can't have a inefficient premium GIC.
But you do give up some liquidity.
You give up liquidity. And I think one of the things that people don't understand about GICs is that you still have risk. You don't have principal at risk, but you still have an economic risk. If interest rates go up, your bond fund is immediately buying new bonds issued at now higher rates.
Right.
The GIC, you've got to wait until it matures before you can reinvest.
Yep.
So there is an economic cost to holding GICs if rates rise, even though you don't see it in your account. And I think the biggest one with GICs, when we're talking about GICs again versus the Vanguard fixed income, is you're max getting 5-year term exposure. And term is a risk, but it's a priced risk. So you would expect a benefit from holding longer maturity bonds over the long term. So moving toward 5-year GICs or even a ladder, which is less, weighted average less than 5 years, you're ending up with...
They're also harder to rebalance too, right? Because you can't sell your GIC to rebalance back to equities.
True, but I think a lot of people would do a mix of GICs and bond funds. But the point is there are these obvious trade-offs between tax efficiency, which you can increase with GICs and ZDB, and portfolio structure, which you give up, I think. You're giving up something by using those holdings. So it's not an obvious, well, if you save tax, you're going to be better off, because you've got to factor in the other trade-offs that are involved in that decision. But the way... That was a long digression. It wasn't a digression. It was just a long discussion. But I think that my main takeaway is that I'm not worried about the tax efficiency of the fixed income in VGRO.
We once did a survey a long time ago, asked clients in the survey what they thought about the tax efficiency of our portfolios, and one of the feedback comments was, I find doing my taxes very quick. I have no issue with the efficiency of getting my tax slips. Like we're talking 20 years ago, so she or he didn't understand what we're talking about with tax efficiency. Little lighter joke. Which clearly didn't go over well. On the next topic.
It just took me a second to get it. That is funny.
So did the next one come from a listener question? So I know it's come up in a few meetings lately. Not
a specific listener question, but it comes up often enough that I thought it was worth talking about.
So the question was, can you over-diversify? So when a lot of people, when they look at index funds, they say, I'm owning everything. I'm owning the good and the bad. I'd rather take out the bad as one example. And it goes back to what you said in the past discussion around dispersion of outcomes. So the more concentrated your portfolio is, the more dispersion you will have for sure.
Yeah, the more dispersion you'd expect, for sure.
Right. So you dug up some papers on this?
Yeah, there are a couple pretty good papers that they don't exactly address dispersion, like that wasn't the purpose of the papers, but they're definitely papers that lend to the discussion. So the first one is from Vanguard, and it talks about active share. So active share is a metric that came out, I think it was 2003 or 2004 when the first paper came out, but it's a measure for how active is a fund. So a fund with high active share would be very different from the index.
Or high conviction fund.
Right. A high conviction fund would be high active share. or a high concentration, I guess. So when someone says index funds are too diversified, another way of saying what they're saying is you should have more active share in your portfolio. So that there was one paper that introduced active share as a metric, another paper that suggested it was a good way to find active funds that outperform. And that research, that paper that came out saying active share identifies good active funds, that got smoked by academic and practitioner literature after it came out. So that didn't last long.
It's also marketing buzz too around few fund companies in Canada with active share funds.
Right, yeah, Dynamic pumps their high active share.
Yeah. Because of course you want someone with high conviction in the stocks.
But you know what? It's true. And Vanguard in their paper, they do point this out. If you're going to go active, you should want high active share. If you're going to pay the fees for active, you should want someone very different from the index. You don't expect necessarily a better outcome.
You don't want to pay active management fees for an index portfolio for sure.
Right. So in Vanguard's paper, they looked at active share as a metric, and they used it to identify. Well, they measured active share and then compared the returns of high active share versus low active share funds. And all they found, which is what you'd expect, is as active share increases, the dispersion of outcomes increases. So funds with high active share were more likely to have extremely high or extremely low returns than low active share, or, well, index funds wouldn't have any.
Which can cause bad behavior.
Well, it can cause bad behavior, but it's also why are you taking on that extra risk of dispersion? Like if you've got such a wide range of outcomes, if you're investing in order to achieve a goal, you don't want a wider range of outcomes. You want a tighter range around your expected outcome.
So why do you think people find these things so appealing? So many people are looking for alternatives like this.
I think there's an element of what would you call it? Like the same reason people play the lottery. I can't remember what the term is. No, not sure. You could call it that. People want to win. People want to win big. People don't want to settle to be average. And then there's probably a lack of familiarity with the data. Like if people understand the data, then you don't want this because it doesn't have an expected benefit. But that's one of the things I took away from the Vanguard paper is that when you increase your concentration, you're increasing your dispersion, but you're not increasing your expected returns. You're probably actually decreasing your expected returns after costs. So you've got this higher dispersion of outcomes without any actual expected benefit on average.
Yeah.
Which, I mean, that doesn't help you achieve a goal. You want a tighter dispersion of outcomes. There's another really good paper from Dimensional, and again, not directly addressing dispersion, but it came at it from a different angle. And they looked at a model portfolio that they built that was tilted towards size, value, and profitability. And they compared it to an index. It was like the MSCI All Country World Index, I think. So they built this global index with a tilt towards size, value, and profitability, compared it to a market cap weighted global index. And they found over the period that they were examining, which was 1994 through 2017, they found that the tilted index beat the market. So there you go. Small cap and value outperformed over that time period. No surprise, we already know that. But what they did that was really interesting is they took the 2,637 stocks that were in this tilted index, and then they sampled from that to reconstruct sub-portfolios of the securities in that index that had the same risk and return characteristics of the index as a whole. So now you've got this broad index, but then you've got a portfolio made out of 50 stocks that has the same risk and expected return as the overall index.
So interesting.
And a portfolio of 100 stocks, portfolio of, I think they did 50, 200, 500, and 1,000 stocks. So each of those portfolios constructed with different numbers of securities, but constructed with perfect hindsight to have the same risk and return as the index as a whole.
And what did they find?
Well, it's exactly what you'd expect based on where our conversation is going. But each of the sub-portfolios, every time that you decrease the number of securities, you decrease the probability of outperforming the index over the period. So even though you've got the same risk and expected return characteristics, each decrease in the number of securities decrease the probability of getting the expected outcome.
Of capturing that excess premium.
Right.
So the point is you need lots of securities to capture that premium more reliably.
Yeah. And they made mention in the in the paper of the fact that we just don't know where expected returns are going to come from. Like we don't know which securities the expected returns are going to come from. There's no way to know that. And we know there's massive skewness in stock returns.
And that's what you'd expect in an efficient market.
Right. Yeah. So anyway, I think that on its own is interesting. Can you over-diversify? I think that the answer is if your goal is achieving a reliable outcome, like, for example, saving for retirement, I think you want a reliable outcome for that purpose. If that's your goal, you cannot over-diversify. If your goal is to knock it out of the park, or if you want to take that risk of a higher dispersion of outcomes, then yeah, diversification is not a good thing. But you're not increasing your expected return by increasing your dispersion.
Exactly.
But I guess the reality is in one person's lifetime, increasing dispersion could have a positive or negative outcome. And some people have a positive outcome, and they tell everyone about it.
Right. Or they become a mutual fund manager.
Right.
Okay, planning topic. Disability insurance. This is an article I came across this week, and I was actually quite taken by the data. So you have disability insurance?
I have, our group policy, but then I also have a top-up.
Yeah.
A top-up plan.
Which is what I have, personal policy as well as our group plan here. So the survey from RBC Insurance found that half of Canadians have no disability insurance coverage, neither through the workplace nor their own private policy, which I find just staggering. Way more people have group disability than individual plans. That I do not find surprising. It's quite often we meet people that have no personal disability coverage at all. Many people just think that, well, the system will provide me with some sort of income, and that's not necessarily true.
Yeah.
Individual plans, if you get one through an insurance company directly, that follows you no matter where you work. You can carry it with you. It never is canceled unless you cancel it. But it's often more expensive than a group plan.
It's for sure more expensive, and it's harder to get. Like with a group policy, you sign up and you're in.
Yeah.
With an individual plan, it's no joke going through underwriting for disability, and they'll exclude any pre-existing conditions. Like if you hurt your back 5 years ago, they'll exclude back injuries.
Yeah,
If you have had any hint of mental illness, like any depression or anything like that, high probability they won't accept you.
But once they've accepted you, you've got the company on the hook. And if you do a claim, and often it's for your own occupation, past 2 years, it could be a lot of money for a long time. And if you're paying the premiums, the benefits are tax-free.
Yeah.
But here's some more stats from it. 62% of Canadians have been exposed to someone who has had to take time off due to disability. 43% have had an immediate family take time off due to disability. 1 in 7 Canadians are disabled at any given time. So they have a little survey on their website. So I did it, and it said that I have a 12% chance of becoming disabled for 90 days or more, and the average length of my disability will be 80 months.
Wow.
So the question is, if that happened to you, are you able to make ends meet while you're disabled?
Without having, any disability insurance.
Correct.
I found another stat that a typical 30-year-old has a 4 times greater chance of becoming disabled than they do of dying before age 65. And most people are all fired up about getting term life insurance, especially if they have houses and kids and things like that. But people don't worry as much about disability. But I think when you're looking at disability coverage, because a lot of people do have group disability. And I think that's...
Not more than half.
Right. But that's the reason that, that was a survey, 1,600 people, I think.
Yeah.
But however many people have group disability, that will cause them not to go and get an individual policy because they think, group disability is done. Even life insurance, I talk to a lot of people who have a group plan for life insurance and they, I've got it through work. Yeah, but like
what if you change your work? The average person now changes their employers more than 5 times on average, I believe. But it's every time you change, that insurance goes away.
It's also not usually sufficient coverage.
No.
Someone might have a few $100,000 through work.
If you're young and typical health, life insurance is really cheap. And this is what gets me about disability insurance, which is much more expensive. People will say, I can't afford that. It's like, let's think about that statement for a minute. The more you can't afford it, the more you can't not afford to get it.
Yeah, the more you need it.
Because if you go on disability, you're basically cooked.
Yeah. So I kind of thought of and dug up a few different things that people should look for. So if you have a group plan, these are things that you can kind of be thinking about. You've got to know what percentage of your income is covered. I find, especially with people who have relatively high incomes, a group plan will cap out.
Yeah, unless you've applied for the
and even then there's
coverage.
Even then there's a cap in most cases.
Yep.
So it's definitely important to know, like you said, Cameron, if there is a way to increase, have you applied for that? Which usually costs, it will cost more. But But even with that, does that cover your expenses? Like if someone has a young family and high expenses, maybe even with that top up, it's not going to be enough coverage. So in that case, you would maybe do what I've done and get an individual plan that sits on top of your group plan. And then it's also really important to know who pays the premiums, because if your employer is paying them for you, the benefit that you receive is taxable. If you pay the premiums yourself, the benefit's tax-free.
Yep.
So for our group plan at PWL, we pay the premiums ourselves.
Yep.
Definitely important to know what the waiting period is. Whenever you've got a disability policy, you become disabled, and it won't start paying until the end of the waiting period, which is X amount of time.
Yeah, 30 the sweet days, 60 spot days. I think is like 90 to 120 days where the price drops a fair amount.
But that also means that you, as the insured, have to have enough savings.
Have to cover off that 4 months.
So you've got to know what is my waiting period so that you've got enough savings to cover yourself.
And payments, I believe, start 30 days after your waiting period is over.
Oh, really?
So it's another month on top. So if you got a 90-day waiting, you could be repaid at day 120.
Interesting. Exclusions for pre-existing conditions. I don't think that applies for a group policy, but definitely for individual policies. You would know when you go through the application process if you have any exclusions. That would be very explicit in the underwriting process. Definitely important to know how long the benefits last.
Normally, personal policies go to age 65.
But a group might be 5 years, 2 years, till 65. It's something that will vary from plan to plan. I think probably one of the biggest ones is how long is the own occupation period.
So it's employment that you're reasonably educated and trained for versus any occupation. So many group plans go to any occupation after 2 years, regardless of your training. So just to be aware of what
that means.
Like
explain what that means to someone who becomes disabled.
So take you, if you become disabled and you only have any occupation policy, after 2 years, if you can go and get any sort of job, whether you have that job or not, it could be working in retail or fast food or something different than what you're trained for. Doesn't matter. That's the end of the coverage.
So it's almost like it becomes increasingly important the more specialized your human capital gets. Like the more technical your career is, the more specialized your work is, the more important it is to have that longer period of own occupation. One of the big ones that I found online, which when I was kind of researching this topic, which I hadn't thought too much about, but it's really interesting, is that group plans don't generally pay for partial disability, but an individual plan will. So that means if I become partially disabled and I can only work half time, my disability plan would cover the difference in my earnings.
So that means the personal plan is incentivizing you to get back to work.
Right. But the group plan just wouldn't pay for partial disability.
Right.
In most cases. That's what I found in my research. And then one of the big ones is that individual plans offer the future purchase option.
Without medical underwriting.
Which
says income underwriting.
So I did that when I bought my disability policy. I purchased that rider, which means every year I get the option to increase my coverage without medical.
Just have to prove that your income is reflective of the new coverage.
Right. Which is super valuable because if something happened to me or if I got sick or injured or whatever, I might not be able to qualify for a new disability policy with higher coverage.
Yeah.
But as long as I keep following along, I'll be able to increase my coverage each year.
And I've come across a lot of people in the past few years that have had refund a premium on their disability policies.
Yeah.
So it's an additional rider. You pay a premium on top of your basic premium, but if you don't make a claim in, I think it's 15 or 20, 25 years, you get all your premiums back.
I think, yeah, I signed up for that. I think it's every 10 maybe. I can't remember the details.
So I've seen some people get back some very significant checks for all their premiums back. Now you're paying for it.
You get half your premiums back, I think, for disability.
Was it? So I've seen some, maybe it's with critical illness.
For critical illness,
all back.
Critical illness will often be all full refund. Anyway, yeah. But I think to summarize that planning topic, disability insurance is probably statistically way more important than life insurance. But at least from what we see, most people are probably underinsured. And the reason is probably because it's expensive and it's also hard to get. But it's something that's worth considering, even if you have a group plan, and even if you don't consider getting an individual policy, it's probably worth looking into the details of your group plan.
Absolutely.
So you know.
Dig it up, and it'll be in a table showing you what percentage of income is covered up to a certain level, and if there's a cap or not. Definitely worth reviewing.
Yeah.
So worst advice from last week. Where did you hear this one?
I found it on I think it was on Motley Fool through Yahoo Finance. But it was, whatever, plain little article, nothing special. But it was two big mistakes that people make in their TFSA, and they weren't wrong. But the insight, the information wasn't wrong, but the insights were not something that I agreed with at all. Bad enough that I would call it the worst advice that I heard last week. These are always hard to find. There's not that much terrible advice out there.
Yeah, we thought it would be easy when we came up with this idea, but it's actually not that easy to do.
Yeah, maybe it's because we're following content that's generally good advice.
Yeah.
We need to subscribe to some investment newsletters or something.
But the first point they made was that some people are being way too conservative with their TFSAs.
Which isn't wrong.
Well, it's good. For many people, that's the last asset you'll ever touch.
Right. Yeah.
So arguably, you can make that the most aggressive account you have.
Yeah. This is a little bit of a digression. I won't take too long here, but I know that Larry Swedrow would disagree with this. He would say that your bonds should go in your tax-free account. And the reason is, in your taxable account, you only own part of the volatility. So if you're targeting, you shouldn't target a mix between stocks and bonds. That doesn't make any sense. You should target a risk-adjusted return. How much risk do you want to take? And you should optimize the amount of expected return for that amount of risk. And based on that framework, putting your equities in your taxable account, you're getting more expected return for less risk because the government's sharing the risk with you due to capital losses. Yeah, wrap your mind around that one. I'm not there in terms of implementing that or anything because I don't think that you can treat losses as offsetting volatility because that assumes perfect replacement for the portfolio when you sell something at a loss. Anyway, so we generally do say higher expected returning assets in the TFSA. So that part of the article I agreed with, but where it went was you should hold aggressive equities. Yeah, I agree, but I would say an ETF. And the article said they suggested some high yielding financial stock. Put this in your TFSA. But what's the problem when you have individual stocks in your TFSA?
Dispersion.
Well, dispersion, but also the potential for permanent loss.
Right.
So if you put $63,500 in your TFSA, max it out, and then buy whatever this financial stock was, I can't remember, and it cuts in half and never comes back, which can happen and does happen, or goes to zero, you've now used up all of your TFSA room and you've got nothing in it.
And no loss to take advantage of it.
And that's the other side of it. No
but if you can't
loss.
pick the ones that go up a lot, of course you want it in your TFSA.
If you can pick them, for sure. But we know what the skewness looks like in stock returns. You're way more likely to lose than you are to pick a winner. So anyway, sure, take risk in your TFSA. I don't disagree with that, but diversification is important, so you don't give up the TFSA room. And plus, if you're going to take, we've talked about this before, if you're going to take risk with individual stocks, do it in your taxable account where you get the capital loss, and you're not risking your registered account room. That stuff is precious.
So you turn the worst advice of the week into a good piece of advice for the week.
Yeah. So that's good.
Anything else?
Nope, that's good for me.
That's a wrap.